In the simplest terms, an interest rate is the price of borrowing money. Think of it like renting a car. You pay a fee to use the car for a certain time. With money, you pay interest to borrow money for a period. The higher the interest rate, the more expensive it is to borrow. Interest rates are everywhere in the economy. They influence mortgages, car loans, business investments, and even the interest you earn on savings accounts. When interest rates are high, borrowing is more expensive. When rates are low, borrowing becomes cheaper. These fluctuations can have significant ripple effects throughout the entire economy. Understanding how interest rates work is essential to grasping how the financial system functions. The decisions made regarding interest rates can either stimulate or stifle economic growth, impacting everyone from large corporations to individual consumers. The entity responsible for managing interest rates in the United States is the Federal Reserve, often referred to as the Fed. The Fed is the nation's central bank, tasked with maintaining a healthy and stable economy. One of its primary tools for achieving this is setting the federal funds rate. The federal funds rate is the interest rate that banks charge each other for overnight loans. While it might seem like an obscure financial mechanism, this rate has a cascading effect on all other interest rates in the economy. When the Fed adjusts the federal funds rate, it indirectly influences the rates you see on mortgages, car loans, and savings accounts. This power to influence interest rates grants the Fed significant control over economic conditions. By carefully adjusting rates, the Fed aims to strike a delicate balance between promoting growth and controlling inflation, a challenge that requires constant monitoring and adjustment. The Federal Reserve adjusts interest rates for various reasons, with the two most common being to control inflation and to stimulate economic growth. Inflation is a rise in the general price level of goods and services in an economy over some period. When prices rise too quickly, it erodes purchasing power and can destabilize the economy. To combat inflation, the Fed might raise interest rates. This makes borrowing more expensive, which can cool down the economy by discouraging spending and reducing demand. Conversely, if the economy is sluggish and unemployment is high, the Fed might lower interest rates to encourage borrowing and investment, thereby stimulating economic activity and job creation. This careful manipulation of interest rates is a balancing act. The Fed must constantly assess economic indicators and make calculated decisions to maintain a stable economy. These decisions are not made in a vacuum. Global events, political climates, and unforeseen crises can all factor into the Fed's decision-making process. Section 4. Businesses on borrowed time. The impact on companies. Changes in interest rates can have a profound impact on businesses of all sizes. When rates rise, the cost of borrowing money increases, making it more expensive for companies to finance expansions, hire new employees, or invest in new equipment. This can stifle growth and even lead to job losses. On the other hand, lower interest rates can be a boon for businesses. Lower borrowing costs can make it easier to invest in new projects, expand operations, and hire more workers. This can lead to increased production, higher profits, and overall economic growth. For example, in the wake of the 2008 financial crisis, the Federal Reserve slashed interest rates to near zero to encourage lending and stimulate the economy. This policy, while not without its critics, is credited with helping to avert a deeper recession and fostering a period of economic recovery. Section 5. Consumers at the counter, spending, saving, and debt. Just as businesses are affected by interest rate changes, so too are consumers. When interest rates rise, it becomes more expensive to borrow money for large purchases like homes and cars. This can dampen consumer demand and slow down the housing market. Additionally, higher interest rates on credit cards can make it more challenging for consumers to manage debt. Conversely, lower interest rates can boost consumer spending by making it cheaper to finance purchases. Lower rates can also make saving less appealing, as the return on savings accounts diminishes. This can encourage consumers to spend more, further stimulating the economy. The impact of interest rate changes on consumers depends on a range of factors, including their employment status, income level, and overall financial health. Understanding how these changes affect personal finances can empower individuals to make informed decisions about spending, saving, and borrowing.